is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded. I am Alex Tapscott here with Andrew Young and nobody else this week. For the first time in quite some time, we don't have a guest. Don't worry, there are lots of great guests coming down the pipe. But this week, we thought we'd take maybe a bit of a breather and let Andrew and I catch up a bit on what's been going on in the news, do a bit of a rundown on some of the sort of big actionable items that we've seen in light of recent macro events, particularly the collapse of several large U.S. regional banks, including Silicon Valley Bank, and also do a rundown of Consensus, the big conference that took place in Austin last week, and talk about what, if any, insights can be gleaned from the biggest confab in the industry every single year. So with that, Andrew, it's nice to see you again.
Yeah, I'm excited to chat. We got Coinbase Perp exchange, we got banking crisis, we got Bitcoin halving coming up. There's a lot to discuss, but why don't we first start with Consensus? How was it? What did you learn? And yeah, just curious what any key lessons from the conference.
Well, it was great to get down to Austin, Texas, a city I haven't been since I was there for a bachelor party. The experience is a little bit different this time, though not as different as you might imagine. Consensus is a bit of a party, and everyone was in fine form, which was interesting because, we're in a pretty tough place in the market. 2022 is, as I've called it, an annus horribilis for crypto. 2023 asset prices have rebounded, but I think there's still plenty of concerns and a lot of anxiety around the VC side of things, whether or not this banking crisis is going to impact the funding for the industry, and of course the regulatory picture in the United States, and whether darkening clouds mean that at some point the government's going to really try and crack down here. But I would say that there was a real sense of optimism within the industry, despite all of the sort of headwinds that I've just described. And that's interesting. And I think, maybe a sign of the times. In past bear markets, there's been this sort of lingering doubt that some people have that, oh, geez, maybe we haven't really reached escape velocity. And this is all going to kind of come crashing down. Whatever technology and innovations we've built, maybe we can't sustain it through this period of down markets. This time, it feels very, very different. I think people are building through the bear market. I think they're really focused on the future. And I think in general, there's like a real sense of optimism. Another big theme is that all the enterprise people that I spoke to are as excited about Web3 as they have been. And that's, bearing out not only in what we saw at the conference, but also in the news. We've seen Visa's beefing up its team. MasterCard similarly is doubling down on crypto. A couple of weeks ago, we saw Nike with .swoosh, Starbucks expanding its loyalty program. All these big companies are still very much focused on the potential here. And that was something very present at the conference. I would say attendance was down quite a bit from last year. I think probably, if I were to guess, and we have friends who are in the events business who did some back of the envelope math on this, there were maybe like 4,000 people in attendance at the actual event. The main stage had 1,200 people. And on the final day, there were, maybe 150 people in the audience for the morning session. Now, Thursday is the big night, so you can kind of understand what may have been contributing to that. But you could just tell that it was a slightly more modest affair than last year. And I would say on the startup side of things, way more projects like talking to you about their capital raises. I think the last year or two, it's been, oh yeah, we've got interest from so-and-so, we're going to do a deal here. This time around, I could tell that the money wasn't as easy to come by. And there were a lot of people who were talking about, raising capital and really keen to, make introductions and talk to other people. So I thought that was sort of interesting as well. So definitely bear market vibes, but overall, I would say the mood was, pretty positive. For me personally, I haven't been really to one of these events. I did go to Masari last year, but outside of that, in a few years, between kids and COVID and everything else, it's been a while. So it was nice to get back out and see some friends I haven't seen in a while.
Yeah, that is interesting. Actually, just real quick on the startup funding raise. So a lot of these startups, they're obviously, we've actually, I think, talked about this a little bit in the past. A lot of them raised huge rounds in 2021.
Yeah.
And typically startups, maybe less so in crypto just because capital is relatively available, but they typically run on kind of 2 to 3 year runways.
Yeah.
So I would think that a lot of startups would be pretty desperate right now to raise. Is that, and on the same hand, I haven't seen too many sort of VC or crypto funds announce huge new funds, at least in the last 12 months. So is there still a lot of dry powder left, or I would have thought VCs have been kind of like maybe tightening the loop and only really doing funding rounds for existing cos?
Well, I can't speak for every VC that's out there, but from the ones that I spoke to, they'll say we've got dry powder. We didn't, deploy it all at the top because they want to project this, the idea that they kept some back. But, that doesn't square with the fact that a lot of these projects seem to use your words, kind of like desperate to raise money. Not like desperate as in they're going to fold up shop, but, willing to talk about down rounds, willing to talk about flat rounds, willing to, get creative. And I don't know, it's just interesting to me to see the kind of tone change. I mean, it's just a reminder that in so many ways, the crypto Web3 space is really feast or famine when it comes to funding. I mean, it's like, how could it be? You have to kind of like wonder, like, how could it be that projects are out of money and VCs, are holding back investing in an industry where, I mean, we've done the math. I think at the peak, there was like something like 12 or 20, I can't remember the number, 12 or $20 billion of venture capital money raised in a single year. I mean, there were times when first time VC investors or institutions or exchanges were like closing billion-dollar rounds like it was nothing, right? So it's like, where's all the money gone? I don't know. I think probably there's, a lot of smart investors sitting on dry powder, but maybe they're waiting for things to get worse before they get better. I can tell you that when it comes to a lot of, deals that happened at the peak of the market, for pre-token projects, they're entertaining like significant repricing of those investments. And I think some of those private investors that bought into the top are going to take huge mark to market down on the next rounds that happen.
Yeah, I think that sort of echoes what I've been hearing. I think it's relatively still calm in the seed round stage. So that just because that's kind of like the most attractive from a risk reward standpoint. And so seed round stage deals seem to still be getting done. It's more the sort of large Series B, Series C rounds that are pretty hard to come by, at least from what I can tell.
Well, that's why you got to grow sustainably.
Yeah, exactly.
Be able to tighten those belt buckles and tighten those, boot straps and pull yourself up by them and whatever. I'm mixing metaphors here, but you got to be able to, grow within your means when the going gets tough, right?
Yeah.
And I know that that's something too that with this, with the banking crisis that's unfolding, a lot of people are worried that the golden era of VC money, the zero interest rate environment, are long behind us. You've been tracking that side of things pretty closely, probably closer than I have. Like, what's your take on current macro conditions, the bank crisis, the read through to crypto, but also the way in which maybe crypto has impacted this? I think a lot of people are trying to make heads and tails of what's going on. Can you enlighten us?
Yeah, for sure. So there's actually been a sort of article going around that explains the whole situation. And apparently it's been sort of making the rounds within the buy-side community, traditional buy-side community. And it's at least credited partly to sort of what's happening in the market. And essentially, obviously we've seen sort of First Republic go down just this weekend to go with Silicon Valley Bank and all the other regionals. But people are now starting to think that over half of America's sort of regional banks could be essentially insolvent, but due to U.S. accounting rules, they're essentially not. They're allowed to effectively hide these losses. And while sort of the technology startup slowdown is obviously what led to Silicon Valley Bank, a lot of the fears now are with the commercial real estate market.
Right.
And essentially, as we know, given sort of the ZIRP, zero interest rate policy,
Yeah.
Banks essentially had to stretch out in terms of the duration, took on more duration risk in order to keep sort of a positive net interest margin and pay their operating cost.
And we should say, just like by what you mean by that is that, you take in deposits and you've got to do something with it. And so some of these deposits were shorter term deposits. And what these banks were doing was buying longer dated bonds where you hold them to maturity, you can earn 4%. But in the meantime, the prices can change a lot based on interest rates. And that can put you in a position where you don't have the liquidity to actually meet redemptions that might happen if people decide to pull their money out.
Yeah, exactly.
Yeah.
And especially with, this has been, in terms of a percentage basis from where we started, this has been, I believe, the fastest rise in interest rates ever, just in terms of going from 0.25% to 5%. So that's roughly a 20x increase in the interest rate. And that obviously hurts long duration treasuries more than short duration treasuries in terms of the price. There's this, obviously, we've talked about this a lot. There's an accounting rule that you can essentially designate certain treasuries as treasuries that you're not going to sell, and therefore you get to mark them at par. But that doesn't really actually reflect reality if you do need to sort of sell those assets to raise liquidity. And so with the market completely spooked, depositors are obviously fleeing weaker banks. At the same time, investors are, and it's kind of a perfect storm. And it's just been crazy. The Fed ended up doing the 25 basis point hike even after sort of Silicon Valley Bank went under. That is starting to look potentially a little dicey now. We obviously have a Fed decision tomorrow, which is pretty critical. I believe it's tomorrow. Given just how perilous the situation is with these smaller regional banks. I actually put out a tweet saying that what's happening right now is kind of like the Canadianization of the U.S. banking system. So,
explain.
In Canada, we obviously sort of have a oligopoly of 5 major banks. There's a couple independents now, but for the most part, there's sort of a big 5 Canadian banks, and they hold pretty much the vast majority of the deposits in the country, and they're very tightly regulated. They're regulated like utilities, and they're actually competitive within each other. But for the most part, it's really it's not a huge amount of sort of free market competition. Yeah. Which is good. I think in some ways it gives stability to society, but it comes at the cost of sort of uncompetitive fees. But anyways, that's kind of what's happening right now in the U.S. banking system. JP Morgan was able to buy First Republic, even though they are technically not allowed to go above 10% of total U.S. deposits. That rule was essentially, I believe that rule was sort of let off the hook for this specific case, just because of how much of an emergency it was. And so what's happening right now is essentially the big U.S. banks are swallowing up all of the regionals, because at the end of the day, why would you keep money at a regional bank if you can get both a higher, in some cases, a higher deposit interest rate at bigger banks, but more importantly, you can get far more safety, because obviously the big banks in the U.S. aren't going to be allowed to fail. The idea is like totally correct, but like every depositor at a federally regulated bank is protected in the United States, but only up to a certain amount, $250,000. And so, for people think, oh, well, this only affects rich people. Well, actually, like, what about every single small business, right? Or a medium-sized enterprise? Like, there are corporate companies employ, a couple people or a few people that need to deposit cash at banks. And, it's not just a matter of someone losing their, cash or something, which is something that is a risk, not trying to trivialize it, but it's also, the potential to have knock-on effects into the economy. So yeah, like the bigger getting bigger, basically. Like JP Morgan seems to be the company or the bank that's rolling up a lot of these smaller firms and looking for concessions and guarantees from the Fed too, while it's at it, right? So to kind of protect its downside in the future as well. It's funny that we're talking so much about banking on a podcast called DeFi Decoded, but it is
it's interesting in that it does sort of reveal some of the problems of centralization that we've seen occur in the past. Now, we're not accusing any of these banks of fraud or anything like that in the way that FTX, was or is likely guilty of that. But we do see this potential problem where trusting a third party can create problems, and it's also created problems for the industry as well, because ultimately, once you have your assets in this space, you can move them peer to peer. You can use smart contracts, but you still need on ramps and off ramps. And a lot of businesses that touch real world assets or engage with clients who have cash need on ramps and off ramps and banking services as well. And it seems like they've lost that in many respects because of the collapse of some of these banks, or at least they're sort of trying to figure out how to adjust and go forward. What do you think of the impact on crypto as a whole?
Yeah, so I think this is actually weirdly very bullish. I mean, there's obviously the first part to this, which is what you mentioned in terms of just kind of proving out the use case of non-fractional reserve system like crypto.
Yeah.
The second sort of key piece is I think this pulls forward the rate the end of the rate hiking cycle, in the sense that a credit crunch is incredibly deflationary. So by having this credit crunch, and also on top of that, having sort of financial instability, lowers the sort of the appetite, or at least should lower the appetite for the Fed to sort of keep hiking. Crypto's obviously, yeah, we would think that. I mean, Powell seems pretty determined to crush inflation no matter what, but crypto is obviously a long tail asset, or long duration, in the sense that most of the value, people value crypto based on its long-term earnings potential and long-term growth potential.
Yeah.
Versus kind of like a value stock. So we're hurt or impacted disproportionately by interest rates, by the discount rate. And so sort of the significant slowdown in inflation over the last couple of months, coupled with this credit crunch, make me have sort of both convinced the markets, but also me, that we may see sort of rates loosening up in maybe not Q4 of this year, but Q1 of next year.
Yeah.
Which is actually really interesting because it times up perfectly with the Bitcoin halving cycle, which is the other thing I wanted to talk about.
Yeah.
So just to kind of give some background, Bitcoin, the way it works is every 4 years, the amount of new Bitcoin that's issued, just based on the issuance sort of schedule, goes down by half. And historically, I mean, we only really have sort of three examples to point to, but historically, this has kind of led to a new bull market in crypto, at least the last 3 times in a row. And it's kind of interesting to see the rate loosening timing coming out exactly with when Bitcoin's halving happens, which is next May, essentially.
Yeah.
It's really just kind of like the perfect storm of ingredients for a significant leg up in crypto. And so to me, I've been kind of like, and I've also noticed this in the newsletters I follow from crypto funds, that the sort of market consensus, which I guess scares me in the sense that probably means it's wrong, but a lot of people that I think are quite smart are sort of saying the same thing, which is the next 6 months may be really tricky in crypto, but the sort of the 6 months after that, so Q4 of this year, could be the start of a significant leg up in crypto, maybe the start of the new bull market. And we've sort of seen that a little bit priced in over the last couple of months. Obviously, Bitcoin rallied from 20K to 30K. But historically, what's happened is these bull markets typically start around 3 to 6 months before the Bitcoin halving. So anyway, it's just kind of interesting that this is all playing out kind of perfectly, in the sense of this decrease in issuance coming with the rate loosening cycle at the same time.
We will see. What happens if it doesn't work out that way? What happens if the halving was priced in all along? and nothing comes of it next year. I wonder what kind of navel gazing will occur in the industry at that point in time.
Yeah, I think part of the reason why the Bitcoin halving has historically led to these bull markets is they typically happens after a sort of long, protracted bear market.
Yeah.
And there's very little liquidity in the market. And so by halving the amount of sell pressure from miners, combining that with a very illiquid crypto market, that the idea is that sort of gives it an initial momentum, which is then fed on by sort of just momentum and investor speculation. So it's not just kind of like a random thing that we're sort of pointing to. It is a decrease of 50% in Bitcoin selling pressure, as we've seen lots of times. Bitcoin, there's almost like a trickle down effect. Bitcoin goes up in price, and then people rotate into Ethereum and alts, and it sort of leads to a broad-based bull market. But anyways, I can only have so much hopium for so long. We should,
right. Exactly.
As you know, I'm a perpetual bull. I guess one thing I really want to chat about, when you were in Consensus, did anyone talk about the new Coinbase Perps exchange that was being launched?
It was a topic. I mean, it just in general, like Coinbase's relationship with the United States more generally would be the topic that was on a lot of people's lips. Obviously, I don't know, we haven't talked about this on the show, but the SEC has been after Coinbase. It was revealed through a Wells notice, and Coinbase took a kind of an extraordinary step and countersued the SEC. So now they're pitted in like a full-blown legal battle. And I think it's just emblematic of the bigger picture in the U.S., which is you've got government agencies and regulators who, are really tightening the screws on the industry. Some would say without justification, or maybe overdoing it, or not seeing the whole picture clearly, or not considering U.S. interests in being a leader in finance and tech and so forth. But the fact of the matter is, like, it is what it is. And I think Coinbase's case, they're looking to, they want to be able to capture this huge marketplace, and I think operating or domiciling in the U.S. makes it tough. What's your take on it?
Oh, sorry, I was muted there. I think it's a long time coming. Perps are, I can't comment too much on the regulatory front in the US. I just don't, it's not something, given that we're not sort of based in the US and stay out of the US, it's not something I follow too much and sort of know a ton about. But I think it is really interesting that Coinbase, like the fact that Coinbase never had a Perps exchange was always a, sort of a huge hole in their product.
Actually, Andrew, maybe for the benefit of the audience, just like, can you talk about what's a perp and the rise of perps and how they've become such a dominant part of like liquidity in the space?
Yeah, for sure. So most crypto trading now is actually done through a product called Perps. Perps actually stands for perpetual futures.
Right.
So essentially, it's similar to a futures product for commodities, things like that. But you don't have to roll over the positions. It's perpetual. You don't have to roll them over, which is a huge benefit for retail, just because rolling them over is obviously very complex. And
like a typical future, like when you say rolling over, like a future's the right to buy something at a future date, or the obligation to buy something at a future date at a future price. And so without a future date, these things have no future date, right? So they just keep rolling on a perpetual basis.
Yeah, exactly. When
it's me and you, we can really drill into like what all this stuff means, because I feel more comfortable interrupting you than I feel interrupting our guests.
That's good. So these products, they're actually created by BitMEX initially. It's sort of what led to the rise of BitMEX. I think it's probably one of the most innovative products ever created, just in terms within the crypto sphere. And they now dwarf spot trading volumes. So like just traditional crypto trading volumes are actually dwarfed by Perps. And the reason why is because you can take out up to 100-to-1 leverage. Some projects actually allow up to 1,000-to-1, which is that's a bit crazy. But so you can essentially with $100 you can buy a $10,000 position. And the idea is if the price goes down by 1%, you essentially get liquidated. So that's obviously the risk you're taking. But if the price goes up, then your gains are magnified 100x. So a 1% gain is actually a double. And then there's a sort of like to keep the positions in line with the sort of index price, there's a funding rate that goes either positive or negative based on if there's more longs or shorts. We don't need to get too much into that, but moral of the story is Perps is the number one product, but they're not allowed, obviously, in the U.S. Or at least there's no sort of license for how you can do them. So what Coinbase is doing is launching. They got a license in Bermuda, and they're launching a Coinbase International Exchange, which essentially bars citizens from, I think, U.S., a couple other jurisdictions. And I think they're starting with 5-to-1 leverage. So you can go $10,000, you can go long $50,000 of BTC and ETH.
5-to-1.
Yeah.
That's baby stuff. 5-to-1.
It's baby stuff. Exactly.
Give me that 1,000-to-1 juice. My God.
Yeah, I think it's more built for institutional clients. I think actually it's purely only allowed. You have to be sort of an institution to be able to trade these initially. I suspect they'll loosen up over time and eventually get to 25, 50-to-1 with a longer, like a more long tail assets, things like BNB or whatnot. So yeah, I think it's a really good move, to be honest with you.
Did you ever read a book called Reminiscences of a Stock Operator?
Yeah, exactly. Yeah, Jesse.
You're very well read for individual. I think you've read all these books. But basically, like the book opens up in a chop shop. So like, this is before the 29 crash, where basically like on street corners in every town, you could go into like a storefront, and there'd be a guy with one of those green brimmed hats with a big chalkboard, and on the chalkboard would be like basically the prices of a bunch of assets. And people like were investing in the market, but all they were doing was like wagering on the price tick, like going ticking up and down. And they were taking these bets, getting 1,500 leverage and getting liquidated all the time. So that's my way of saying, I think that there's some concern that that kind of leverage can be harmful for people that don't know what they're doing, right? I mean, that's true for, like, we've seen people using options, even listed regulated options on Robinhood. So, I wonder if there's what the downside is to getting into this market, if any. And I guess, you and I shouldn't opine too much on the U.S. regulatory front for several reasons. I mean, 9 points of regulated entity, but also to your point, like, we're not experts, right? But you have to think that when you're embroiled in a dispute with the SEC, that something like this, I don't know, maybe it draws even more attention to what you're doing. I'm not sure.
Yeah, it's definitely a bit bold in terms of its time. But just to kind of go back though, so I'll talk about the downside second, but there is the upside to doing this is there's a massive hole in this market, an FTX sized hole in this perp market for crypto hedge funds and things like that. So Coinbase is sort of leveraging their incredible brand and bringing it to a sphere that up until now has not really had any sort of, not illegitimate, but like no kind of blue chip worthy brands. For the most part, I guess besides Binance, but Binance has had its own sort of struggles with regulators. So I think this is a huge opportunity for Coinbase. The risk, though, to answer your question, Jesse Livermore, as you said, he was so profitable as a stock picker that he'd actually often get banned from these bucket shops because they were essentially taking the other side of the bets with him. It's almost like a traditional sports betting company in a way.
Yeah, exactly.
And what's interesting, though, is FTX effectively blew up because Alameda was on the other side of their customers' bets. And when you include that much leverage, I guess what I'm trying to say is this is definitely a product that has blow up risk. So I'm not sure. I assume Coinbase is doing this completely legit. I'm sure they have some of the top market makers on their site or on their platform, but it is interesting. It's definitely a very bold and sort of risky move, but again, I think there's an FTX sized hole in this market. And so I think if it doesn't hurt them too much on the regulatory front, I think, huge potential.
Yeah, no, absolutely. And can't comment on what's going on inside their business, but I've always held them in high esteem. They're a counterparty of ours, and I'll have only good things to say about how they've done business. Yeah, I use Bucket Shop. I use Chop Shop, which is a different kind of sort of untoward business that chops up stolen vehicles. That's not what I was talking about. I was talking about a bucket shop. Anyway, on that cheerful note, anything else that we missed today, AY, that we should be talking about?
No, those were really the main three things. I think, the funny thing is the banking crisis, or this whole segment on the banking crisis could be at a date by tomorrow, given how fast things are moving. So we'll have to monitor that. And it's almost like the Luna moment for U.S. banking. Remember, we did a segment on Luna and it was out of date by the next day, so we had to reshoot it.
I remember that.
Kind of feels like that right now with U.S. banking, but I think we'll see. Tomorrow's going to be really interesting with the Fed as well. It's just probably be glued to the screen watching that a little bit over the next couple days. Well,
we'll see. And one of the themes that kind of ran through this episode is that the clouds seem to be gathering on the regulatory front in the U.S., but we're not the right people to be digging into that too deep. And that's the good news is we're going to have a guest next week who is kind of one of the most important people in this whole discussion. I can't say who it is, but it's going to be a pretty awesome chat. So make sure you tune in next week. That is it for this week's DeFi Decoded. Until next time, I'm Alex Tapscott here with Andrew Young. Take care and have a good one. See ya.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.